The market isn't bleeding because companies are failing. It's bleeding because of a perfect storm. If you look at your portfolio right now, it probably looks like a crime scene. Red everywhere. Panic in the news. But you need to understand one critical thing right now. Most investors are losing money because they don't know the difference between a broken company and a broken market. They are two very different things. Right now, 4 specific massive hits are landing on the economy all at the same time. It's like getting punched from 4 different directions. First, there is a massive AI scare. Second, big players are taking their profits off the table. Third, China is tightening up on metals. And fourth, the US dollar is facing some serious headwinds. When all 4 of these things hit at once, the market stops thinking. It stops using logic. It just reacts. It panics. So every major sell-off looks like the end of the world. But if you turn around and actually look at the data, you realize something. This is not a company problem. Microsoft didn't suddenly forget how to make software. NVIDIA didn't stop selling chips. This is a positioning problem. So we need to separate the fear from the opportunity. I'm going to show you exactly why big tech is getting punished, where the smart money is moving, and how to position yourself so you don't get washed away. And stick around, because I've found 3 specific stocks that are actually flying under the radar right now. 2 of them are under $100. You probably haven't heard of them, but the charts look incredible. But first, we have to fix your mindset. Before you click sell, before you panic, you have to ask yourself 3 questions. This is the filter. Number 1, is this a company event? Did the CEO get fired? Did they lose a lawsuit? Number 2, is this an industry event? Is the whole sector struggling? Or number 3, is this a stock market event? Right now, we are in a stock market event. The entire ocean is rough. It doesn't mean your boat is broken. It just means there are big waves. Let's look at the first wave, the AI scare. Software stocks are getting hammered. A few weeks ago, the writing was on the wall for short stocks like Microsoft, Adobe, and ServiceNow. Why? Because there is a rumor, a ghost story. There is this idea that a new AI model from a company called Anthropic is going to come out and just destroy the competition. The market feels like this one new piece of tech is going to put massive giants like Salesforce and Oracle out of business overnight. Does that sound realistic to you? Probably not. But we have seen this movie before. Remember DeepSeek? That Chinese company came out and everyone screamed that it was the end of NVIDIA. The stock tanked, panic selling everywhere. And what happened? We found out DeepSeek was using NVIDIA's technology anyway. Wall Street has a bad habit. They price in the what if before they look at the reality. They price in the disruption before it actually happens. It's crazy, but that is how the game is played. They shoot first and ask questions later. But you don't have the luxury of being that emotional. You have to be cold. Then you have the second wave, profit taking. Think about the last 3 years. The market has been on an incredible run. Stocks like NVIDIA crashed 40%, then turned around and shot up. Big investors are sitting on massive piles of cash, and now they are cashing out. Taking chips off the table is a normal part of the game. And don't forget the calendar. We are in an election cycle. Historically, looking at the data, midterm election years are tricky. Usually you get a down market. The average drop is about 18%. That hurts. Nobody likes seeing their account drop 18%. But here's the catch. After that drop, the average bounce back is 37%. Think about that math. You have to endure the 18% drop to qualify for the 37% gain. It's the toll you have to pay to cross the bridge. So what does this mean for you? It doesn't mean you go cash. It doesn't mean you sell everything and hide under the bed. It means you have 2 choices. You can buy these dips while everyone else is crying, or you can reposition your money to where the market is actually going. Selling just because you see red isn't a strategy, it's a reaction. And reactions lose money. Conviction makes money. If you sell now, you are making a fatal mistake. Here's the math. If you miss just the 10 best days in the market, your returns get cut in half. That's it. Just 10 days determine if you retire rich or if you keep working. And if you are sitting on the sideline because you're scared, you are guaranteed to miss those days. You miss the bounce. While everyone else is crying while watching big tech get punished, the smart money is quietly moving. They are rewarding companies with actual pricing power, companies that execute. This is where the disciplined capital is going. But before I give you this first stock, which is trading under $100, I need you to see the bigger picture. Look at Amazon, look at Palantir, look at Microsoft. These companies are posting phenomenal numbers. They are making money hand over fist. And what does the market do? It punishes them. Amazon crushed earnings, but the stock dropped. Why? Because of CapEx. Because they are spending money to build the future. Now stop listening to the noise. Stop buying into the AI bubble myth. Think about it logically. Do you think Amazon is going to spend billions of dollars if they thought it was a bubble? Do you think Mark Zuckerberg at Meta is lighting cash on fire for no reason? Do you think Microsoft is spending hundreds of billions on a whim? No. Rich people don't get rich by being stupid. They grow their wealth by growing their business. That is what CapEx is. It's an investment, not a loss. Even the CEO of NVIDIA is confused. He's looking at software stocks down 30%, hitting 52-week lows, and shaking his head. The market thinks this is okay. It's not. The market is being irrational. It's acting like a toddler. The market is never technically wrong, but it is frequently crazy. So, you have a problem right now? Your portfolio is heavy on tech, and tech is getting beaten up. You want stability? You want a stock that goes up even when the economy gets weird. I have found a stock that is doing exactly that. It's up big this year, but nobody is talking about it. I'm going to give you the ticker in just a second, but first you have to understand why this specific sector is bulletproof. The ticker symbol is GOLF, G-O-L-F. This is a small cap company, and the chart is a thing of beauty. It's up 24% year to date. It's up 142% in the last 5 years. This isn't hype. This isn't AI smoke and mirrors. This is real demand from real customers. So what do? It's in the name. They are the foundation of the entire golf ecosystem. They own the balls, the clubs, the gear, the apparel. If you play golf seriously, you are giving this company money, period. This is why I love fundamental investing. This business doesn't care about the Fed's interest rates. It doesn't care about AI disruption. It doesn't need ChatGPT to sell a driver. It just needs the same guys on Wall Street, the ones selling your tech stocks, to go play 18 holes on the weekend. Golf is not a hobby. For these people, it is a habit. It is an addiction. Golf is not discretionary spending. It's mandatory. If the Fed is hawkish, people still golf. If the economy is bad, people still golf. In fact, if things get really bad, they might skip the expensive family vacation to Europe, but they will not skip their Saturday morning tea time. They might even go on a cheaper vacation to a golf course. Here's the atomic truth. Experience-based spending is stronger than tech spending during a recession. I'll say that again because it's important. When people are scared, they stop buying gadgets. They don't stop buying experiences. They don't stop living their lives. And golf has something most companies dream of. They have brand authority. If they raise the price of their golf balls, the customer doesn't leave. They don't go buy a cheap generic ball. Why? Because performance matters. You don't mess with your golf game just to save $2. The richer you get and the older you get, the more you golf. That is a locked-in customer base. That is real pricing power. We aren't talking about Starbucks pricing power where I can just make coffee at home. You can't make a golf ball at home. This company isn't surviving quarter to quarter. It is thriving. It has a fortress balance sheet. It has cash on hand. Lots of it. And in a market like this, cash is king. This is the beauty of a company like golf. It doesn't need to beg for money. It doesn't need an IPO. It doesn't need to sell debt to sharks on Wall Street. It has its own engine. It has a recurring revenue model that prints money. That means you don't have to worry about emergency dilution, where your shares suddenly become worth less. You don't have to worry about desperate loans. When the market gets tight, most companies play defense. They curl up in a ball, but golf plays offense. Why? Because when the wealthy close their laptops, when the hedge fund managers step away from the panic, and when the quant traders stop their algorithms, where do they go? They go to the golf course. In volatile markets, capital rotates. Money is alive. It runs away from stories and hype, and it runs toward execution. It wants safety. Golf checks every single box. It's profitable. It generates cash. It has global demand, and it does not care about AI. That is why it is up double digits this year while your tech stocks are bleeding. That is why it is up triple digits over 5 years. But listen, I have 2 more stocks for you, and trust me, the next one is even more surprising than the first. So hang in there. Rock with me, because we need to talk about the elephant in the room. We need to talk about China. This is the silent killer affecting your portfolio right now. People think China is just scaring the markets. No, it is controlling the inputs. We are talking about rare earth minerals. We are talking about silver. We are talking about the raw materials that build the modern world. China isn't just selling stuff anymore. They are positioning themselves. They are building alliances against the American economy. They want the yuan to be the world reserve currency. They want to knock the dollar off the throne. These metals aren't just commodities to them. They are strategic weapons. And this leads directly to the 4th hit on our list, the dollar itself. The US dollar is losing its muscle. Countries are selling off US debt like it's expired milk. They are buying gold instead. We are walking into a new regime, a new set of rules for the global economy. Now, this sounds terrifying, I know. It sounds like the sky is falling. But here is the secret. Uncertainty does not crash markets. It just pauses them. It makes them hold their breath. The crash happens in your account when you panic. Every time you sell because you're scared, you lock in the loss. You say, I'll get out now and get back in later. But you never do. You miss the opportunity. Think back to last year. NVIDIA dropped 30%. It fell to $83. People said it was over. Then what happened? It ran straight up to $200. Palantir touched $7 last year. Everyone said it was trash. Then it ran to $21. We saw amazing companies get torched, down 30%, 40%, 50% in April. Everyone was screaming fire. But by May, they were rallying. By June, they were soaring. By October, all-time highs. This time is the same. Do not listen to the people who say this time is different. It is never different. The market has no new tricks. It just wears a different mask. Veterans who have been trading for 10 or 20 years, don't panic. They look at the chart and say, oh, I've seen this episode before. I'm not a guru. I don't have a crystal ball. But I have seen this movie. When Meta, Facebook, was at $89, people told me, I don't know, Trap. That looks risky. Today it's over $600. When Netflix crashed to $170 in 2022, people said streaming was dead. Now look at it. The pressure feels tight right now. I know it does. It feels heavy. You check your phone and your stomach drops. But you have to zoom out. We have been here before, and we will be here again. The question isn't, will the market recover? The question is, will you still own the stocks when it does? So we've covered the fear, we've covered the first stock, but now we need to look at where else the money is hiding. Because there is another sector that is quietly making people rich while tech burns. And this next stock, nobody sees it coming. My emotions are screaming, sell. Your brain is screaming, get out. That is your nervous system frying. I told my team last night, when the market closes, you need to close the laptop, turn off the iPhone, go take a hot bath, take some magnesium. You need to physically calm down because your body is reacting to fear. But this isn't real fear. This is forced selling. The market is twisting your arm, trying to make you tap out. And if you tap out now, you lose. You hand over your wealth to someone else. Don't let the headlines fool you. They are designed for clicks, not for your bank account. They sell panic. I sell perspective. The cycle never changes. The market does not reward patience loudly. It doesn't give you a gold star today. It rewards patience later. It pays you in quiet, massive gains years down the road. You want to be the person who says, yep, I bought Palantir when it was $13. I bought NVIDIA when it was $80. I remember buying NVIDIA on a plane from Paris when it was tanking. Everyone thought I was crazy. Now they call me lucky. It wasn't luck. It was an understanding of infrastructure. And infrastructure behaves very differently from tech. It doesn't move fast. It moves heavily. This brings me to the second stock I promised you. And full disclosure, I used to work for these guys back in the day in Lake Charles. I've seen this beast from the inside. The company is Fluor, ticker symbol FLR. Fluor doesn't sell ideas. They don't sell dreams. They build the things that civilization needs to function. They build energy infrastructure. They build LNG facilities. They build data centers. They build defense projects for the government. When I was working with them, we were building massive LNG facilities. These projects are funded before the stock market even knows they exist. We are talking about contracts worth hundreds of millions of dollars. These aren't optional. You don't just cancel a billion-dollar power plant because the CPI report came in hot. Right now, Fluor is up 12% this year. It's up 159% in the last 5 years. This is real growth based on ink and paper contracts, not invisible forecasts. Fluor doesn't care about quarterly sentiment. They operate on multi-year timelines. Once a project is approved, it's a freight train. It doesn't stop for inflation. It doesn't stop for unemployment numbers. It doesn't stop for a housing crash. It just keeps rolling. And here is their secret weapon, cash flow. In a downturn, cash is oxygen. If you run out of cash, you die. Fluor has a strategic cash advantage. They have a free cash flow strength. They don't have forced dilution. They don't need to beg banks for emergency loans. They absorb volatility while other companies break. So while the market is punishing the story stocks, it is rewarding the builder stocks, the risk builders. These companies survive the winter and dominate the summer. When money gets sucked out of the market, the government still builds bridges. When money floods back in, the government still builds power plants. I want you to sleep well at night. I don't want you staring at the ceiling wondering if your portfolio went to zero. And remember, I'm not a financial advisor. This isn't advice, it's education. I want you to stop looking at the same 5 tech stocks over and over again. Branch out. Fluor operates globally, but it doesn't rely on you. It doesn't rely on consumer spending. If you stop buying lattes, Fluor doesn't care. Their customers are governments, energy giants, the people who run the world. Their revenue is tied to national security and infrastructure cycles, not your mood. When markets panic, they sell stories. But governments don't stop building. That is why infrastructure quietly outperforms during chaos. So we have golf for the consumer habit. We have Fluor for the industrial muscle. But I have one last stock for you, and I have to warn you, this one is boring. And that is exactly the point. The ticker is WTS, Watts Water Technologies. This is boring, and boring pays. Boring keeps writing checks when excitement collapses. In a bull market, you look for excitement. You look for the next NVIDIA. You look for the next Google. You chase the shiny object. But in a market like this, you don't want shiny, you want bulletproof. I'm going to break down exactly why this boring stock is about to become your favorite asset, but you have to understand one thing first. Water is the new gold. You are addicted to the hype. You're looking for the next Palantir. You're hunting for the next supermicro computer. You want the stocks that explode overnight. And while you are chasing fireworks, you are missing the quiet giants that are outperforming the big dogs year after year after year. This is Watts Water Technologies, WTS. They make the systems that control water flow, water pressure, and safety. We are talking about plumbing infrastructure, commercial skyscrapers, residential homes, and industrial factories. This company does it all. Here's the atomic rule. If water moves through a building, this company is involved. Think about that for a second. Look around you. Think of every building you have entered in the last week, every office, every store, every house. They all have water moving through them, and WTS owns that flow. Nobody delays water safety. Nobody says, hey, let's skip the pressure control this year. Nobody ignores plumbing regulations. You literally can't. The government won't let you open the doors. This creates inelastic demand. That means no matter what the price is, people have to buy it. You can't negotiate with a leaking pipe. You can't negotiate with a regulator. You just pay the bill. And because pipes break and valves wear out, you have a recurring replacement cycle that never ends. Regulation drives their sales automatically. They don't need a marketing team. They have the law. This company is playing the long game. They are up 12% year to date. They are up 155% in the last 5 years. I really went into the lab and found some bangers for you today. This isn't luck. This is research. Their balance sheet is disciplined. WTS doesn't chase growth at all costs like these tech startups. They protect their margins, they manage the cost, they manage the chaos, and then they simply return that capital to you, the shareholder. They stay profitable. These are the stocks you buy so you can turn off your phone and sleep. You don't need to check the ticker every 5 minutes. Institutions trust them because they are boring. They don't have drama. They don't have scandals. They just have predictable cash flow and elite execution. While everyone is screaming about AI and chips, companies like this are quietly making millionaires. They don't get the TV coverage because water pressure valves aren't sexy. But you know what is sexy? Profit. So look at the pattern I just gave you. First, golf. That gives us experience, spending, and pricing power. Second, Fluor. That gives us infrastructure and contracted cash flow. Third, WTS. That gives us necessity and execution discipline. None of them depends on AI. None of them has narrative risk. None of them requires you to believe in a vision. No tariff risk. No deep-seek rumors, no massive capex spending. It is just raw demand outperforming the hype. When the market punishes the storytellers, it rewards the builders. It rewards boredom. But here's the thing. Even with these 3 stocks in your arsenal, you are still exposed to one major risk we touched on earlier. The dollar itself. We talked about countries dumping U.S. debt, but there is a specific asset that moves in the exact opposite direction of the dollar. And if you don't have exposure to this asset, your purchasing power is melting away while you sleep. I broke down exactly how to hedge against the dying dollar in this video right here. Click this video. It's the insurance policy your portfolio is missing. I'll see you over there.